Welcome to Northland's The Artisan Podcast. The objective is to provide a deeper understanding of the complex challenges investors face today and the risks and opportunities we see for tomorrow. In today's episode, we ask, Bitcoin Fintech, is the bubble bursting? Well, I guess if you look at the last couple weeks, the answer is an obvious yes, with Bitcoin cratering by over 50%, top to bottom. However, this is not unusual for Bitcoin and happens every year or two. And these pullbacks have proved fabulous buying opportunities. In fact, Bitcoin has been the best performing asset over the last 10 years. If you had invested just $1,000 10 years ago, you'd be worth $40 million today. But I guess then you wouldn't be listening to today's webcast, you'd be on a beach somewhere sipping pina coladas. So how do we make sense of this chaos? Well, luckily, we're joined by two experts with us today to help us out. First, there's Arthur Salzer, the Chief Investment Officer of Northland Wealth Management, and one of the first institutional investors in Bitcoin in Canada, and Peter Misek, founder of Framework Ventures, one of North America's leading experts in fintech. So gun to head, Arthur. Bitcoin, up, down, or sideways?
After what we've experienced, that carnage in the market where we've seen basically every leverage position blown out of the water this week, I'd have to say it's upwards from here.
But, I mean, surely Bitcoin's a bubble. I mean, just look at Dogecoin, created purely as a joke and up 10,000%. I mean, Bitcoin has no cash flow. How do you possibly value an asset like that? What framework do you use to say whether it was worth the 60,000 a few weeks ago, 30,000 a few days ago, or somewhere in between?
So first off, it is what we call an ultra-cyclical. So it is an asset class that periodically has bubbles, and we've seen these bubbles occur pretty much every 4 years around the halving cycle. So when you look at a valuation perspective, it can go back, and the first time I was learning about tech was in the early 80s. And at the time, Sony had Betamax, and Betamax was a smaller tape, higher quality picture than VHS. But VHS offered a broader selection of titles for its audience. And people, instead of choosing Betamax, they wanted the selection, and they went with VHS, even though the product may not have been as well. The same occurred when you look at a technology perspective with Apple versus RIM. RIM had much better security, much easier to type on to send messages to each other, fully encrypted. However, it didn't have apps. It didn't have games. And what we saw was the network expanded faster on Apple, and Apple dominated that cell phone marketplace. And really, that's what we're seeing today with Bitcoin, where there is a gradual adaptation. It's at about the same rate or even slightly faster than what we saw with cell phones or what we call smartphones today. And at the same time, there's a halving. So the block reward every 4 years gets reduced by half. So initially, back in 2010, when the first Bitcoin was being mined, what we saw was a block reward of 50 Bitcoin pretty much every 10 minutes. And today, we're only at a fraction of that. So the new supply coming on is much, much lower every 10 minutes, yet the adaptation is increasing. And you do get periods of FOMO, fear of missing out, where people chase. We've seen it with tulips. We've seen it with many asset classes, tech stocks even in early 2000, and then dramatic pullbacks. So you have to understand that cycle if you're going to put capital to work in Bitcoin.
So I guess you're saying that it is driven by fundamentals, and the fundamentals are supply and demand. And can you use the actual levels of supply and demand to predict a price? So in other words, you haven't answered the question yet, whether 60,000 2 weeks ago was correct, 30,000 a few days ago, or somewhere in between. Can you get more definitive in a model?
If you're pricing it against Metcalf, and I've seen studies done, or against stock to flow, which is how gold is measured, or diamonds or water, you have a very, very high correlation around this increased network adaptation along with the new supply being reduced. And it's a very, very tight graph. The challenge really is the day-to-day volatility around that. The one standard deviation or two standard deviations is still quite large, but when you track it over the years, it's very, very close.
Okay,
and we're basically tracking where it should be.
I guess you bring up a good question. You can have the view as to the long term. As I mentioned at the start, the long term Bitcoin has gone up tremendously, but with these hugely volatile moves in between, from a trading perspective, how do you manage that for clients? I know that you put clients into Bitcoin at about $7,000-8,000. I mean, did you ride all the way up to 60 and back to where we are today, or how do you manage things from a shorter term perspective within that long term, more positive thesis?
From a portfolio manager's perspective, it's about managing the risk of the portfolio, both real risk, fundamental risk that an investment fails, and then secondly, based on price. So asset allocation and right sizing the position makes a huge difference. So on average, we took a 5% allocation. We had read a Yale study that recommended 6.5 for the best return versus risk. 1% made a huge difference to a balanced portfolio. But where we were in the cycle, knowing that we typically experience the best of a bull market 18 months after the halving, that's why we went with a larger allocation of 5%. And what we do typically is rebalance plus or minus a 50% move. So if 5% grows to north of 7.5, we rebalance down and bring it back. Subsequently, if we saw a drawdown of 50%, so 5% went to 2.5, we would add to bring it back up to 8. But this is definitely an asset class you have to rebalance.
So is it fair to say that in the last several years you've rebalanced several times, and then has it declined by enough recently to rebalance back up?
We've been selling realistically for the past, call it 7 to 8 months. We probably could have rebalanced in March of 2020 when it drew down 50% in a day, but it was down there for such a short period of time. We just said, let's not do it. Okay. That's really what it's about. But if it stayed down there for a longer period of time, we would. However, again, Bitcoin is something that is ultra cyclical. And if we do see a blow off top, like we've seen in previous markets, where it's 100% increase in typically 2 weeks, you really do want to go to close to 0.8 or 0.8. It's like the tech bubble on steroids. So it's really something that you got to sell into. So our initial allocations for most families were done in tax-free savings accounts. So we didn't have the tax tail wagging the investment dog. We didn't want to have that consideration on the sell that, somebody's going to have to pay tax. Let's just take that out of the picture.
And so let's put things in context of the recent sell-off. The recent sell-off is basically it's due to environmental criticism from none less than Elon Musk. Stopped accepting Bitcoin for the purchase of Teslas because in his view, it is very unkind to the environment and has a negative impact on the carbon footprint. I mean, come on, Arthur. Bitcoin uses more electricity than Sweden, and by the nature of the algorithm, it will use ever more electricity going forward. I mean, in what way, shape, or form is that sustainable?
Well, that's what it is. It's a store of value. I mean, Einstein came up with the theory of relativity, E equals mc squared, and now it's E equals mc squared equals BTC. So energy is never created, it's never destroyed, it simply moves from one form to another. And what BTC is a digital form of storage for energy that can be moved nowadays anywhere in the world. And what you're seeing is a greater adaptation from what we would call green or renewable power, where the new battery is becoming Bitcoin. You mine Bitcoin. When you have excess power that typically we would dump or we would sell at a loss, that now can be stored digitally, and I think it's going to change the valuations and change the usage of solar and of wind power.
So, Peter, do you buy that? I know that you have a bit of a different view in terms of the environmental impact of Bitcoin.
I think this is a big Achilles heel that the blockchain and the technology has to figure out. And it's an incremental usage of electricity. It does not subsume or replace other money movement or other stores of value. And so for the time being, this is a problem that's going to become bigger, and it doesn't match up with millennials' desires to be eco-friendly. So Bitcoin and green, they don't currently work.
So, I mean, I that makes a lot of sense to me, Arthur. Is there any way that Bitcoin can respond and adapt? I mean, that's the very nature of technology historically, is its ability to adapt to change. I mean, otherwise none of us would be here today.
And that's why there's multiple studies debunking that argument. I'll share them after. We won't go too much further, but I'm happy to share them, and then maybe one time, Peter, we can go for a beer and have a passionate discussion.
Okay, enough about the environment. Another criticism of Bitcoin is, I mean, you can hardly use it. Transactions are extremely slow. Visa's doing 25,000 transactions a second. Bitcoin can hardly do 5. I mean, how is that useful?
It does 7, but that's close enough to 5 for all practical purposes. So really, what you're getting is Bitcoin was never designed as a payment layer. It's not designed for that. If you want to have payment, you have to build a network above another layer. And that's why you're seeing networks like Lightning, which will do transactions at hundreds of thousands of times faster than the current payment systems and use less electricity. So I think that's where you're going to see those payments come in. But yeah, using blockchain for anything other than a store of value is probably very silly, and the energy usage doesn't make a lot of sense.
And how about the cost? I mean, $30 a transaction and rising, according to a very legitimate source, Coinbase. I mean, how's that competitive?
It's not. It's going to be to move larger amounts of money. But then again, I've seen $1 billion move for $7 in transaction fees. So the trick really is it's not a payment layer; it's a settlement layer, and a payment layer you have to build above, and that's why you got to look at Lightning.
Okay, and what about the argument that it can become a victim of its own success? So it's going to be self-defeating. I mean, if you look at the U.S. government, it makes a tremendous amount of money off seniorage, and they can get away with murder, right? They can print tons of money. They can have whatever fiscal deficit they want. It all gets funded at a very low interest rate. So if this is a threat to the U.S. government, why can't they just say Bitcoin's illegal, and then the price goes from 40,000 to, well, 0?
It won't go to 0. I mean, yes.
Okay, 1 to 1
on that news. Pardon?
To 1.
There's enough countries in the world that's not the United States or not Canada or not the Western world where the currencies are completely unstable, where the money printing is much, much faster than anything we see here. And what you're seeing in those countries is an adaptation of Bitcoin to get around a system that's broken. With monetary controls, I mean, they would have originally gone to USD, but they can't use USD in those countries. So the way to get around it is you use a smartphone and use digital currency, and that's what's being done. But yeah, I mean, sure you'd have massive pullback. You can make it illegal for a while, but you can't stop it, and that's what makes it interesting. The U.S. government, outlawed Netscape. And because it was on a single server, it disappeared. And the same happened to LimeWire and a bunch of others. And then comes along BitTorrent. And as much as the U.S. government or any other government may like it or not, it's robust enough that it can't be shut down. So it's a very, very different system. And I think what you're going to see, based on the research that we've done at Northland, and we met with the heads of Fidelity Digital, we met with the heads of ErisX, met with the heads of Bakkt, which is owned by the owners of the NYSE, met with the heads of some of the other major banks, And the infrastructure and the plumbing is getting built for Bitcoin. And I think you're going to see greater and greater use there.
Yeah, I mean, it makes sense to me. Makes sense to me whether it's Bitcoin or another alternative currency. I think we're too far gone to go back now, and so maybe for now that's enough about Bitcoin. Peter, what do you think about some of the other cryptocurrencies?
Well, our biggest challenge is we don't make bets on any individual cryptocurrency.
Okay.
What we look at is infrastructure. So,
okay, yeah.
In fintech, what we're looking for are companies that can provide services that reduce or remove the pain of something that a customer is feeling. A custodianship of crypto assets is an area that we're very keen on. Obviously, the infrastructure layer around payments, enabling payments. Trying to create solutions around how energy storage can truly be used to make the grid more robust, more friendly, whether it's superconductors or whether it's hydrogen creation at endpoints. Those are all technologies that we evaluate. But stepping back, we look at roughly 1,000 companies a month. And those 1,000 companies a month, roughly 20% are fintech. And we now track over 21,000 companies across North America, across 65 data fields. And we use that for the benefit of the ecosystem. So any company that calls us, we let them know how they rank.
Okay, that certainly makes a lot of sense to me. And if we go back to the 90s tech bubble, I mean, the safer way to play it was to buy, the arms dealers rather than the countries that were actually fighting. So a lot of the telecom service providers actually went bankrupt, but the ones producing the income made a tremendous amount of profit and are still around today. So if we look at that infrastructure, what do you see as the big themes? Like what part of that infrastructure should we be invested in right now? Where are we seeing the innovation? And if you can throw out a couple names, fantastic.
Yeah, so what we think is that we'll break it into the short term and the long term. Over the long term, we see ARM infrastructure pervading in the cloud. ARM is going to cause 100 to 1,000x increase in computing power in 10 years or less.
Right. Yeah.
And that's going to be breathtaking what that does. It's going to have profound implications across the world, machine learning, AI, and even the blockchain. What we think shorter term is we're seeing is the pandemic caused 10 years of innovation to be slammed into 1 to 2 years. And so we're looking for companies like a Wave Financial, like Accounting Up, that reimagine financial services and deliver them in a way that truly solves friction. Or we're looking at companies that can transform education, like Paper, that reduce the education gap. Now that people know you can actually learn online, but it's preferable to have in person. And so you combine the two and you really close this educational gap. And so in our portfolio, we're seeing unbelievable growth in companies that have taken advantage of this generational innovation cycle that's been caused by the pandemic and are really, really solving big problems.
So maybe you just pull out one of those examples and go into a little bit more depth, a Wave or one of the others.
So let's start with Paper, because I'm passionate about education. I think education is the big equalizer. It removes racial barriers. It removes gender barriers. It removes barriers, period. The more educated your population is, the better off you as a country are. And right now, the pandemic exposed that the Western world is very difficult to say that we have an equitable education program, especially in the United States. So imagine an ability to offer 24/7 tutoring for an entire school district at a flat fee. And you're doing that with live tutors that are powered by AI that can at any one time take the surges of demand and be able to do that in a very, very scalable fashion. And imagine the US government just gave you, all those districts, $200 billion to spend over the next 5 years. And that's a recipe for finally solving the education gap. And Paper is the only company in North America that can do it on a scale that really will make an impact. So they now serve almost 1 million students in the United States, making them the second largest district. They're going to be serving 10 million students in the next year or so.
That's fantastic.
And so I think that education is very exciting, and it's certainly getting disrupted right now. More quickly because of COVID, and this is happening, at all different levels. Maybe we can just kind of gear down for a moment into a few sectors that you had mentioned. Maybe you can say what'll go on in maybe the next 3 to 5 years, and some companies to play that. So if we look at payments, particularly on the mobile side, the emerging markets have figured it out. We look at Ant Financial in China. It's so big the government had to limit them. The market cap is billions upon billions upon billions. But in North America, we haven't figured out mobile payments yet. We're getting there, but it's unclear, and it looks like there will be a big number one and a number two to keep them honest. How do you see mobile payments adapting in North America and Europe, and let's say over the next 3 to 5 years? And who's going to be the winner? Who's going to be the next PayPal, so that we couldn't invest in Bitcoin 10 years ago? Maybe we can invest in them now, and then we can be sipping pina coladas 10 years from now.
Yeah, that'd be great. So we think payments are going to be integrated in applications that people use every day, and that the payment layer will become completely seamless. And so for us, Fintech is not about digitizing financial services. It's about reimagining them and embedding them in applications people use every day. I think the biggest winners of the integrated payments will be Square. I think the next biggest winner will be Apple and Google. Now, private companies, we think companies that reimagine and embed these financial products and services, like Accounting Up, like an Incode, those are two of our portfolio companies. They are going to dramatically make payments faster, easier, and almost completely secure, more secure than you visiting a branch. And so those companies in our portfolio are seeing 5x, 10x annual growth. And that's the kind of performance that when you see these companies get the problem solved right, that customers flock to them.
So it certainly makes sense. Maybe going a little bit more broad than that, and maybe I'm completely wrong here, but I see a few different areas in fintech where there's legacy companies that are collecting excess rents for basically doing nothing. I mean, I just bought a house. Don't tell my agent this, but I mean, those guys got paid 5% for a lot of money for essentially doing nothing. Is there anything that is going to disrupt that part of the market, so that, I mean, if those commissions go down to, let's say, what they're worth, so from 4 to 5% to 50 basis points, that's money the seller and the buyer can share. Is there any potential disruptors either in the U.S. or Canada?
There's lots of disruptors. The problem is, in both countries, the government lobby groups have been incredibly successful at ensuring MLS has not been fully open, and have been very, very, very good at enforcing those lobby groups' interests. It is the most breathtakingly unregulated, uncompliant industry in North America right now. It is a travesty. Every government official should be shaking their head and ask themselves, if you have a real estate agent who literally has to spend 40 hours of education and has seen their earnings 10x in 10 years for the same effort, it makes no sense. Every other industry, digital has been brought in to disrupt that and make it more efficient, and the governments will not allow it. It's mind-blowing.
Yeah.
You're right, Peter. I probably should have stayed in real estate. I got my real estate license in 1988.
but Arthur's,
nobody got that run.
Arthur's much more educated. I mean, don't tell him this, but the education of my agent is he was a swimming instructor. That's the level. But he is actually a fantastic agent. And what about Visa, Mastercard? You said you covered them for years. We have this oligopoly where they're getting 2 or 3%. Now they are doing something valuable. Don't get me wrong. It's just it's not worth 2 or 3%. It's worth 40 basis points. So where do you see that industry going? Are the king and queen, are they going to lose their crowns? And if so, who are the potential winners?
Well, so the Durban Agreement really exposed what all of the layers and fees are. Just to be clear, the Durban Agreement shows that interchange can average between 50 basis points and 110. So let's be crystal clear. The 2% or plus that you get charged is because the issuers, the banks, the people who've providing you the plastic have layered in services, whether it's loyalty points, other things, to claim the value of those extra basis points. So the rails themselves cost between 50 and 110 basis points. They serve a great purpose. They need to invest, need to evolve. There's somewhere in the neighborhood of $100 billion that needs to be invested globally in those rails to make them real time and make them more useful. But ultimately, we see that being compressed significantly over time. And the value creation will be on taking that data and layering in other services, whether it's credit on demand, identity, other things that remove other friction points.
So speaking of identity, have you looked at Microsoft's identity overlay network, Ion?
Mm-hmm.
What are your thoughts on it?
It's a great first step. A lot more that needs to be done. Identity, big problem in my opinion, is the endpoints. The transportation of identity is less of an issue in our research. The bigger issue is the authentication and re-authentication that needs to occur on a regular basis. But it's a great first step.
That actually brings up a very valid question. It really doesn't matter whether you're doing the fintech or any other area of VC, but you've always been able to make lots of money on cybersecurity prevention if you have the right tools or company. Is that a theme that you play?
It's a theme we play within our vertical. So we want to see AI exploited at an unbelievable million-x improvement over existing systems. And so one of our companies, Incode, actually does that. And so they are anywhere between 1,000 and 1,000,000x better than existing systems.
Okay, and then what about the question? I mean, I did my MBA a year ago. Half my class was Indian software engineers. That was here, and here they'd get paid, I don't know, $300,000 plus a year. In Silicon Valley, the Canadian equivalent of $500,000. In India, they were getting under $100,000. So, I mean, why shouldn't all of these services go out to India, where you have tremendous entrepreneurs, you have very high level of intellectual capital. So you combine those things together, you've got a real innovation hub. Why aren't all the exciting companies coming out of India, rather than Canada or the U.S.?
Well, so there are a lot of exciting companies coming out of India. There's somewhere around 100,000 startups in India. Lots of unicorns coming out of the country. And offshoring, just to put this in perspective, it used to be an Indian software engineer back in the early 2000s made $5,000 a year. So they've actually seen a 20x increase in their salaries. That has allowed a lot of innovation and a lot of inflation to be held in a balance. And so what we continue to see is we're going to see over time, a lot of those software engineers in remote locations are going to see the price of their goods and their service match the clearing here in North America. And so we see an equilibrium. The problem is globally there's a shortage of almost 1 million plus software engineers. Right. And there will be a shortage of 5 million in less than 5 years. It is a staggering problem for society.
Okay, so there you have it. I mean, there's two ways to become wealthy. One is to go back 10 years and invest in Bitcoin, and the other is today to become a software engineer. So we've got a few more minutes left. Peter, maybe you can mention some of your big themes over the next 3 to 5 years.
Yeah, our big theme is we want to invest in companies that have great core businesses, but where we can layer in financial products and services. So think payments, think lending, think money movement, think money management, inside applications and services people and businesses use every day. And then the other side, companies that produce huge amounts of data that we can productize using machine learning and create or innovate to really, really push both the financial side, but also push the problems that they're solving at the other end. So it is a 10, 20-year horizon that we see these themes playing out over.
Okay, so to wrap up, I have one question for each of you. Actually, it's not a question. It's an answer. So please provide this in the form of a question. If you were given $1,000 right now and could only invest in one thing, what would it be?
You go ahead, Arthur.
I think today you'd buy Bitcoin still.
Peter?
I'd invest in my venture fund.
Okay, fair. Certainly makes sense. I mean, thank goodness our listeners and Northland investors, well, we can do both because diversification is the only free lunch in finance. So if anyone has any follow-up questions, you can email me at jabramson, that's A-B-R-A-M like Mary, S-O-N like Nancy, at northlandwealth.com. Thank you, and have a wonderful day.
Thanks, Peter. Thanks, Joe.
Thanks, guys. I got to jump.
Cheers.
Cheers.
Okay,
Bye.
just let it